Prepower community cooperatives provide a way for investors and consumers to share in the profits from cheaper renewable energy. In this presentation, I will compare traditional investing with Prepower investing and illustrate how sharing profits produces better outcomes for investors and consumers. Better outcomes happen because it costs less to operate long-term investments using Prepower investing approach. With traditional investments, investors purchase assets and they receive a share of the profits from the assets. With the Prepower approach to investing, both investors and consumers purchase future production. The time for consumers to receive their share of the profits is less, while investors get higher returns. With both traditional and Prepower investment, profits are shared. With traditional investing, investors get all the money profits, while in a free market, consumers are meant to get their share of the profits with lower prices. With Prepower investing, investors get a fixed return when the investment produces electricity and is sold. Consumers take on the price risk and get their share of the profits with lower prices and with a share of future production. At the moment, for renewable energy, the Prepower approach doubles the return of investment compared to Australian super fund returns, and it halves the long-term cost to consumers compared to buying electricity from the grid. Let us look at consumers of electricity. Traditionally, consumers pay after consumption. They pay a fixed price and they pay for energy that comes from the grid and may or may not be renewable. With Prepower, they pay a fixed amount 1 month in advance, 70% of the regulated price, and 50% of each payment pays for future electricity. They also get renewable energy. Let us now look at investors. Investors of $10,000 in the average Australian superannuation fund will receive $83 indexed for inflation per month for 10.75 years. The returns are fixed. If the investor decides to change the rate at which they receive their money back, they pay fees. They only get the returns in the form of taxable money. With Prepower, they receive $83 indexed for inflation per month for 20 years. They can vary how quickly they get their money back, and they can add in new investments or take out lump sums at any time. There are no fees in operating their Prepower account, and they receive their money back as a return of capital, which is taxable as capital gains or as electricity where it is not taxed. Homeowners can get the same returns on investment by having panels themselves and not using a cooperative. However, they will get similar returns if they invest with others through a Prepower cooperative, while having greater flexibility and less risk when working with others. It also allows those who cannot raise the funds for their own solar panels to benefit as investors by consuming and paying for cooperative electricity. It also allows those who already have solar panels to be able to invest in other people's solar. Renewable energy investment returns compare well with other businesses, as solar panels give a 20% return on investment, even if only 50% of electricity is consumed inside the house. Prepower provides a cheaper way to invest than traditional investing. This happens because instead of shares or loans, there are only prepayments, and there is no need to transfer funds outside the cooperative business. To find out more, go to prepower.org. Send us an email or attend a Thursday information session.